I want to focus on the next minutes on the practical side of implementing rolling forecast as an instrument to optimize decision taking. On the next page, I start with an example of stock market. Namely, what I show here is Wirecard. This is a former DAX member, a very famous member. The DAX is the leading German share price index. What you see is that the share price showed a tremendous rise from 2015 up to 2018. Then it went slightly down till 2020. And at June 18, you had a totally crash of the share price. What was astonishing is that already in April 2015, Financial Times reported about inconsistencies in the balance sheet. But it took 5 years up to German finance authorities, the BaFin, started and accused the Wirecard management. Police started investigations, and at June 18, Ernst & Young refused test date. After that, the share price crashed. So if you look at that development, if you were an investor in Wirecard, it would have been very important that you have a clear goal. For example, you say, I want to at least have 50% gain, but not more than 20% loss. If you want to reach such a goal, what is really obvious and natural is that you check things like stock price development, company news, market environment. You check such things on a rolling base to take your decision for buying or selling the stock. In that example, it would have been enough to check the things every week. So you would have had enough information to sell the stock before June 18. On the next page. On the other side, if you would have followed as an investor just a budget philosophy, let's say you set a yearly target of 10%, you report deviations. If you follow such a philosophy and you look at the year 2020, from the 1st of January up to the 17th of June, you see a small reduction of share price from 3.4%. So this is not a dramatic development. It's just in a normal range. So you wouldn't have had any indication to sell your stock. So just following a budget way, you have much more, your risk is greater to lose all your money you have than when you have implemented rolling forecast. So on the next page, the learnings of this example is you should have clear overall goals. These goals are fixed over time. They are not depending on market conditions, so they stay stable. This is by the way how you implement beyond budgeting goals. You have a clear decision focus. This is buying or selling a stock, and then you have to establish a natural rhythm to update the rolling forecast based on the decision you want to take. Here, as I told you, for the stock market, this was on a weekly basis. You also have to adjust the frequency of your decision-taking meetings. If you make a rolling forecast, you always have to implement also a decision meeting. Otherwise, a rolling forecast is useless. You have to identify all your drivers, stock price movements, company news, market environment. You have to update all your drivers in the forecast process. And what is really important, if you have many stocks, you cannot do it all by hand. So it would be very helpful to automate the processes. And not every stock, for example, needs the same checkup rhythm. So these are the learnings we have out of this simple Wirecard example. Perhaps you are also investing in stocks, so you know such an environment. On the next page, we switch to our company, SBB Cargo. You see here our delivery network within Switzerland. We have a clear goal. We want to adjust our resources to the volume developments, and we want to do it as accurate as possible and as fast as possible, just to have a good profitability. So on the next page, you see that our decision focus is clear. What about our natural rhythm? How did we implement it? On a weekly base, we make sales updates on actual gains and losses. And then on a 2-weekly base, we have short-term resource adjustments based on the sales update. On a quarterly basis, we make midterm adjustments of the whole network, including changes of pickup and delivery times at our client side. So on a quarterly basis, we address our clients to switch, for example, some delivery times. And on a yearly basis, we make long-term adjustments by buying, renting, selling, hiring, and dismissing resources. So we have our natural rhythm. The drivers are the market environment, client performance, and client decisions. Of course, our clients can decide to switch the provider, so we have to know it, as we can plan, as we can decide it a little bit before. And what we also see is, to be as accurate and as fast as possible, we need a very high granularity in this process. So we need the information in a very detailed form where the volumes are changing. So we need here an automated process. We need machine algorithm. So we need here helpful tools that support us in doing our forecast. On the next page, here I show you the example of our long-term capacity adjustment. So we do our long-term forecast, our long-term rolling forecast on a quarterly base. What you see here was the forecast done by November 2018. What you see is that we have a forecast that said that our volumes are dropping by 20 to 25% in the year 2020. So this forecast was done more than 1 year before COVID pandemic started, and it gave us the insight that we could take our decisions in the right way. So it is very important. But what I want to show you also is that this insight, we got it by looking at the forward period of 4 years. So we didn't just take a forward-looking period of 12 months or 18 months, but we look forward by 4 years here in the long-term capacity process. If we wouldn't have done it, the forecast would just say, okay, it is a development like in the year 12 and 13, so no problem. So we didn't have to adjust our resources. But looking a little bit further and making forecast assumptions, then you see that the volume could drop, and therefore you can take at the time and at the right moment your capacity decisions. So this is an example how important it is, based on the decisions you want to take, to adjust your parameters, to adjust your forward looking periods. On the next page, we also actually have weaknesses in our process. The board of directors, for example, still will have a yearly budget, so they are very traditional. They don't support us, like in the Maersk example, to move the whole company in the direction of only using rolling forecast. The flexibility of our workforce due to labor contracts is at the moment lower than the agility of our forecast process. So of course, as agile as we can forecast, we should be able to switch or to change our resources. That at the moment we have weaknesses. And of course, we don't have all information from our clients. They don't tell us everything what they are planning to do. And the automation of the forecast process is just at the beginning. It's still some elements that are done by hand. So I'm at the end of my presentation. I thank for your attention. I want to show you how natural it is to use rolling forecast for taking active decisions. Thank you very much.